The last bit when we start talking about investments is when we're going to talk about investment portfolios. So an investment portfolio is when you have one or more investments held by an individual investor or organization. The portfolio basically means all of your accounts. So meaning you can have things that are earning simple interest. You can earn one lump sum that's earning compounding interest, or you can be putting a similar or the same amount away at regular intervals. That's also going to be earning compounding interest. So our first example, and actually our only example for this, is in 10 years, we want to know which portfolio will have a greater rate of return. Jason's portfolio or Mario's? So Jason's portfolio, he has a 10-year $2,000 GIC that earns 4.2% compounded semi-annually. A savings account that earns 1.6 or 1.8% compounded weekly, where he saves 55% every week, and a 5-year $4,000 bond that earns 3.9% compounded quarterly, which he will reinvest in another bond at an interest rate of 4.1%. Mari's has a tax-free savings account, or a TFSA, that earns 2.2 compounded monthly and a current balance of $5,600. She also purchases at the end of each year of a 10-year $500 Canada savings bond that earns 3.6% compound annually, and a savings account that earns 1.6% compounded monthly, where she saves $200 each month. So on this page, I'm just going to calculate Jason's rate of return. So for Jason, the first bit of his portfolio is he has a $2,000 guaranteed investment certificate, which means we're using the one account compounding interest formula. So $2,000, rate of 4.2%, compounded semi-annually for 10 years. Typing that into the calculator. Yes, I've already done that calculation, that should be 20. We have $3,030.71. The second thing is he has a savings account that earns 1.8 compounded weekly, where he saves $55 every week. Well, which formula is that going to use? Well, he's saving $55 every single week, which means he's making a regular contribution to it. So regular and plug in the information. $55 at an interest rate of 1.8%. Compounded weekly, there are 52 weeks in a year. Now we ask ourselves a time. Well, we're asking for in 10 years, so we can assume that he's investing that entire thing, or putting $55 away every single week for the 10 years. Oh, sorry, just 520. You can absolutely plug all of that straight into your calculator. $20, subtracting a 1, divide by 0.18 divided by 52. We get $31,329.72. And finally, last, a 5-year $4,000 bond that earns 3.9% compound quarterly, which he will reinvest in another bond that gets a 4.1%, which means that we're going to be using the single investment, but we're going to have to do it 2 times. So that $4,000 gets put away at 3.9% first, compounded quarterly for 5 years, which means we're dealing with a 20 as our exponent. Get $4,856.65, but then he reinvests it in another bond at 4.1%. So this would be the first one. The second one, I'm just going to save a little bit of room, a little bit of work. Compounding quarterly, we can probably assume again. For the remaining 5 years of this entire value. So 4856.65. Oh, then divide by 4. $5,955.44 would be his final value. Well, that is not his rate of return. His rate of return, by calculation, by definition, is how much is earned or lost divided by how much is invested. Well, in the first account, he's invested $2,000. How much of that is interest is $1,030.71. In this account, he's putting $55 away every single week for 10 years. So the $55 times 52 weeks times 10 years is $28,600. So to find out how much of this is interest, we have to find out the difference. $28,600 we get $2,729.72. And finally, in this one, if it's finally worth $5,955.44, he had only put $4,000 away in it. That means $1,955.44 would be interest. So the rate of return would be taking how much interest is earned, adding all of that up. Oh, sorry, 27. So adding up only the interest and dividing it by how much was actually invested. So $2,000 in the first one, $28,600. The second one, $4,000. The third one. I'm just going to take this one step at a time. He would have earned $5,000 $715.87 of interest and had put in $34,600 of interest, or initially invested. So if I take my 5715.87 divided by the 34,600, I get 0.165198555, which means he has a rate of return of 16.5% on his investments. We're going to do the same calculations for Mari, however the pronunciation is. So she has TFSA that earns 2.2. Current balance of $5,600. Compounded. So I'm just going to do screen capture and put it on the back side too. So I just did a quick screen capture just so I don't have to keep on flipping pages. It's being compounded monthly for the 10 years, which means that we're working with 120 as our exponent. Make sure I plugged everything in correctly. Yep, she looks good. $6,976.62. She purchases at the end of each year a 10-year $500 Canada Savings Bond. Now this one's a little bit trickier, but really what she's doing is she's putting $500 away every single year. Now, the fact that each year she's purchasing a 10-year bond, sometimes bonds can be redeemed before their actual maturity. In this case, we'll have to assume that she actually is able to redeem them all at the end of the 10-year total. So 0.36 compounded annually. So she's putting $500 away every single year in all practicality. And that gets typed into my calculator. We get $5,892.88. The final savings account that she earns 1.6% compounded monthly, where she saves $200 each month. Same formula, just different dollar amount and different interest amount, or sorry, interest rate. Compounded monthly, so different monthly compounding periods as well. Zero 1 6 over 12. We get $26,000. Sorry, $26,007.87. So how much are we working with for interest? So again, we still want to find out her rate of return. 69, 76, 62, subtracting the $5,600 works out to be $1,376.62. $500 away for 10 years works out as $5,000. So the 5892.88, and the difference with that $5,000 works out as $892.88. Putting $200 away every single month for 10 years works out to be $24,000. So to find out that difference, to find out how much of that $26,000 is interest, we have to find out our difference. Our final step is to find out what is her rate of return. So our 1,376.62, add the 892.88, add the $2,007.87, divided by the total amount that she had actually invested, 5,600, 5,000, and the 24,000 works out. And 5,000. So that number looks familiar. Yep, they both would have invested the same amount. Now, obviously, just by chance, Jason had been able to achieve more interest by getting $5,700. Mary had $4,277. So meaning Jason would have a higher rate of return. How much higher? Well, we'd have to calculate it out. Well, Mary gets a 12.4% rate return, but Jason got a 16.5% rate. Is there anything left in the question? Who has a higher? On this case, Jason has a higher rate of return. All right. Now you can go have fun.